Hey, look at that. Time for the show. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Tuesday, the 10th of January. I'm JD Durkin. That's what the box says. Opening bell rung moments ago by the NYC Department of Buildings. Milrose Consultants, John Gallen & Son, Inc. Stocks are trading. We're in like mixed territory. At least a minute and 30 seconds into the trading session. This is investors eagerly await additional clues. It's like a game of Blue's Clues. Remember the show Blue's Clues with the little things around the house? You try and figure out how to solve the puzzle. Well, that's basically what we're doing with slightly more money involved. We try and look into the central bank's next move as Fed Chair Jay Powell fields questions in Stockholm. Investors are still feeling a little skittish on continued fears that the U.S. economy could tip into a recession. Let's take a look for what is on tap for this morning's broadcast. We will talk Fed expectations as investors continue to digest hawkish comments, specifically from two Fed members yesterday. We will ask Martin Baccardax about those comments in just a moment. Plus, we dig into the crypto contagion as Coinbase lays off another chunk of its workforce as crypto winter gets colder. And finally, we discuss what is going on with Bed Bath & Beyond as that company tries to avoid bankruptcy. For more on those stories and so much more, we now welcome in our chief markets correspondent, Mr. Martin Baccardax. Martin, have you ever been to Stockholm?
I have been to Stockholm. I've been to Stockholm and to Gothenburg, which is a Swedish city on the south of the country. I was there for the World Athletics Championships many years ago.
Oof! It's a beautiful city. You've enjoyed it. I've enjoyed it. And as we speak, the chairman of the Federal Reserve, Mr. Jerome Powell, is enjoying it as well. It's a speech largely geared on Fed independence, though we know there will be a Q&A session. Martin, how closely should we be following what Powell has to say in that Q&A, even on a relatively unrelated topic?
Yeah, I think it will be interesting to see whether he does field any questions with respect to the current situation of of both economic growth, inflation, and jobs here in the United States. He didn't make direct reference to it in his prepared remarks, and they were, for the most part, sort of focused on the role of central bank independence. He said quite a bit about the impact of climate change on financial stability and other sort of risks that the Fed would otherwise be tasked to mitigate, but didn't necessarily get too deep into the weeds with regards to inflation forecasts and all the rest of it. He essentially just said that taming inflation is going to require decisions that won't be very popular, and I don't think there's going to be any controversy with regards to that. But JD, I think the fact might be that he decided not to lean against market expectations in this speech, when perhaps he could have, is going to be seen as potentially a tacit, dovish nod to the anticipation of slowing inflation, which may lead to a change in Fed trajectory. Of course, we are a long way from seeing anything concrete, but I do wonder if there was some method to that madness this morning, where the chairman decided not to lean against the rally that he saw last week and indeed yesterday, which he has done on many occasions before, and whether that might have a meaningful import for those looking at his remarks and preparing for the inflation data on Thursday.
Yeah, yesterday was an interesting trading session. A lot of green on the big board until we got comments from two Fed officials. As we speak now, 4 minutes and change into today's session, the S&P up 0.2, NASDAQ up 0.4 or so, the S&P crossing back over the 3,900 level. With regards to those comments yesterday here, Martin, Fed Presidents Mary Daly of San Francisco, Raphael Bostic of Atlanta, doubling down on the central bank's view inflation still too perhaps stubborn, too far away from the preferred target of 2%. Mr. Bostic there indicating, yeah, we'll hit 5% and we're going to keep them there for a long time. How long a ways away are we from potential rate cuts? Is that nowhere near the horizon? And what did you take away from the comments we heard yesterday?
Well, I think to your first question, we are nowhere near it, but ultimately these things are advanced by degrees, and they begin with signaling and they are accelerated by specific messaging, and then ultimately they are confirmed by market expectations. What struck me yesterday, JD, was the difference in market reaction. Mary Daly's comments were interesting because she said she could present an argument for either a 25 or a 50 basis point rate increase when the Fed meets at the end of the month. They'll deliver the interest rate decision on February 1st, but the two-day meeting will begin on the 31st of January. I felt that that was important. I thought the fact that she talked about, again, not wanting to be premature in terms of changing tack was also important. And Mr. Bostic's suggestion, as you illustrated, that rates are going to remain high for the bulk of the year was also something of significance. But what struck me, JD, was the difference in market reaction. Stocks paired gains almost immediately on the back of those comments and really only limped into the finish line as a result. But the bond market kept rallying, and that surprised me. People kept purchasing bonds, and yields kept falling lower, and kind of holding at those levels again in this morning's trading. So we are seeing that disconnect between the consistent hawkish messaging from the Federal Reserve and the bond market's anticipation of where rates are going to be. The two-year notes, as I last saw, were trading somewhere around 4.25%. That's still a long, long way from the 5% plus that the Fed has told us the Fed funds rate is going to be in the springtime. So the bond market continues to challenge that consensus. And it was surprising to me that they did it yesterday in the face of explicit hawkish commentary, which turned stocks lower. So again, that disconnect, I think, is going to be really important going forward.
But now, is it not more advantageous for bond buyers to buy newly issued bonds on the hopes that rates are higher, given the potential for higher yields, as opposed to sort of cheapening of price of previously issued bonds? I mean, how should we view the bonds that are going around the bond market versus new bonds that people are buying based on things like hawkish comments?
They should all essentially be fungible if they're in and around the same maturity. So whether the paper is new or old, there might be a liquidity premium for new paper, but for the most part, if they're in and around the same maturity, they should ultimately be fungible to those that already exist. And again, it's just worth iterating that bond prices and bond yields move in opposite directions. So when people are scooping up this paper and the price increases, then yields are going to simultaneously, almost in lockstep, move in the opposite direction. And again, what we see typically in this situation is that investors are pricing two-year Treasury notes in anticipation of Fed rate hikes, but they're purchasing 10-year bonds as almost a backstop against economic risk. In other words, if they see the economy weakening and the potential returns from the stock market dwindling, they will park money in risk-free assets like Treasury bonds in order to protect their capital and wait out the storm. So that's where you get that inverted yield curve. You get higher short-term rates in anticipation of a hawkish Fed, and you get lower long-term rates in anticipation of weaker economic growth. And the steeper that difference becomes, the more recession risk there is.
If the Fed has been clear, which many officials have been, that rates will go above 5%, will stay there, at least the federal funds rate will stay there for longer, will it even matter much to investors if we only end up seeing a moderate incremental hike of, let's say, 25 basis points outside of maybe a one-day relief rally? Because you've done a really good job here, Martin, to indicate that we're not really on the same page. I don't know if it's investors in the indexes not necessarily believing the Fed, but I mean, what you're saying, I mean, if we get 25, I'd have to imagine we get that little bit of a knee-jerk relief rally. But will it even matter? Because I feel like officials are trying to be very, very clear and communicative about the long-term prospects for where they're taking this thing.
It's really about unraveling the onion, I think, to some degree, JD, because you're absolutely right. In normal circumstances, the destination would be much more important than the increments to get there. But now, because there is doubt about the Fed messaging, and because we know that a large degree of the Fed messaging is really simply to counteract the policy mistake it made last year when it described, in 2020, when it described inflation as transitory, we will probably now see more volatility around smaller rate decisions simply because the markets will see that as a change in the destination. And I think they might actually be right about that. I was reading some analysis this morning that suggests that the PCE index, the core PCE index, which is really the Fed's preferred and most important inflation gauge, could be as low as 2.25% by June, and even lower heading into the summertime, assuming again that we don't get anything crazy on the energy price front. If that's the case, and the labor market moves in the direction that we think it is, we will be closer to consistent 2% inflation conditions. And that will by no means justify a Fed funds rate of 5% plus. So I think the market is not only pushing against the hawkish Fed rhetoric, but it is doing its own calculus, its own arithmetic, and its own linear equation to see where inflation rates are very likely to end up. And if that is the case, they are going to see smaller Fed rate decisions as being an agreement with the Fed and the market rather than just simply a wait and see approach that will get us to the same destination. I'm a bit long-winded in that, but what I'm saying is that, yes, the destination would have been more important a few months ago. Now I think the increments are going to be just as important.
Martin, you and I talked about yesterday possible distortions, if you will, in the JOLTS data, how the 10.4 million figure may be a bit overstated, overemphasized perhaps by the central bank. But I wonder if those distortions, if I could use that word, really matter if it is so important, if it's really what the Fed is using as a crucial justification for raising rates. I mean, whether or not it's overstated, if it's kind of like perception drives reality, right? If it's the number the Fed is basing a lot of its consideration on out of concern for higher wages and then more stubborn higher pricing and then a justification to keep rates higher, whether or not it's actually 10.4, if the Fed says it's 10.4, isn't it just 10.4?
There's a lot of truth to that. I mean, I'm not comparing the two data points in any way, shape, or form, but this argument has been put forth with regards to the numbers that we see from China on a month-to-month and a quarter-by-quarter basis. Not everyone believes in their accuracy, but those are the numbers that everybody has to deal with. So as a result, you have to put them into your calculators, into your models, and into your spreadsheet, whether you like it or not. So I think your point is absolutely spot on. Whether or not we accept the fact that the JOLTS data is purely representative of the amount of people who are on the sidelines on the job market and waiting to come in is almost irrelevant. If the Fed sees it as so, it is going to be an important part of their calculus, and therefore it has to be the case for those on the investment front as well. Now, the big difference, of course, is that people who are on the investment front, analysis and economists and all the rest of it, are going to try to get an advantage by being ahead of the Fed thinking, and as a result, being able to offer information and advice to their clients so that they can be positioned correctly if and probably when the Fed changes its perspective. So that's why I think some people are pushing against these JOLTS figures. But for the most part, I do think your point is incredibly critical, and that is if it is part of the Fed's calculus, it cannot be ignored.
Yeah, absolutely. And we know it is. We've heard that from Mr. Powell and colleagues to say it's important, but I thought it was a really important point that you very well drove home yesterday that I do want to make sure I touch back on, and it gives us new context and perspective and something I hope we can revisit in future conversations. I do want to ask you about the U.S. dollar index stabilizing a bit now near 6-month lows. Martin, what's behind this movement?
It bounced up a bit in overnight trading. I can't fully explain why, to be perfectly honest, JD, because we had Treasury yields holding at these lower levels. It might have been just a little bit of relief. There didn't particularly seem to be a driving force behind it. I haven't seen it in the last moments or so. But my suspicion is that we are going to see it abate a little bit as a result of the fact that Chairman Powell didn't speak directly hard to sort of understand because of the breadth and depth of the foreign exchange market. The dollar index pegs it the greenback against a basket of 6 global currencies, the 6 most popularly traded global currencies. And the volumes in all of those 6 are just astronomical. So there can be conditions in where it moves quickly in either direction on seemingly not a lot of headline news. And I think that's probably what we saw this morning.
Can we go back to regular Fed talk as we're just getting some additional comments here out of Chair Powell abroad? Obviously, this is, if you don't mind double backing, you don't like to do that. I like to keep the show on a very straight path, right? So you pass one exit, we're done with that topic, now we go on to the next, but I do want to revisit this, stressing the need for the Fed's political independence as the efforts continue to tackle inflation. For people that have always heard these headlines and say, okay, yes, sure, okay, Fed independence, that's great. Why? Why is this so important for Fed independence, especially through the lens of history, where we know that there have been previous people who are doing Jay Powell's unenviable job who have faced pressure from people like, I don't know, the then president of the United States to sort of chip away at that perception of Fed independence. This is a pretty important perception for Mr. Powell to uphold, isn't it?
No, it's critical. It's critical for all central banks, and the Fed in particular. I think central bank independence took a really big sort of hit during the sort of trough of the financial crisis, when it seemed as though central banks were working in concert with government officials, probably rightly so, in order to tamp down the stability risks that had been ignited as a result of the housing crisis and the collapse in financial markets, but also in holding their policy rates at these historically low levels in a way that some people thought was, again, in concert with government in order to help them repair not only the federal balance sheets, but the broader economic growth prospect at the same time. What you really don't want, however, JD, is the assumption that central banks are working with government on a specific and targeted basis. In other words, you don't want a profligate government to be propped up by a central bank that's going to keep rates artificially low, because that, of course, is only going to engender the kind of inflation that will be long-term damaging to any economy. You need to have the independence of a central bank authority that is going to weather the sort of messaging from government officials, whether they come from the president, the prime minister, or whomever, and execute their mandate with that kind of clarity. Now, the Fed's mandate, of course, is full employment and price stability. So therefore, they have to think through those twin conditions, despite what they're hearing from their political leaders. Now, Mr. Powell talked about that this morning with respect to pressure regarding climate change and its impact on financial stability, economic growth, and ultimately inflation. But said, in my view, quite rightly, that it's not part of their mandate at the moment. They have only very narrow perspectives in which they can tweak their reaction function against climate risk. And until they are given a mandate to have climate risk informed as part of their broader mandate, and they can only have that through Congress, it wouldn't be right for them to execute it independently. Again, I think that's absolutely valid and a nod, I think, to the kind of climate rhetoric that we have been seeing from central banks in other parts of the world, particularly in Europe.
So you have used the word here that's earning itself a few headlines, even in just the last hour. Is that largely what Chair Powell means when he says the Fed cannot and will not be a climate policymaker?
Yes, exactly. Part of the political pushback to his being reaffirmed as Fed chair came from, I guess, what some people would describe as the progressive wing of the Democratic Party, which were unconvinced with regards to his climate bona fides and whether or not he was going to incorporate the climate change risk into the Fed's stability and full employment mandate. So I think to some degree, he is addressing those concerns with what he is saying this morning. But again, quite rightly, just reiterating that until he has delivered that kind of mandate from Congress, he simply is not going to have it formed part of the Fed's thinking.
All right, absolutely. Powell here saying it's inappropriate for Fed to use its tools to promote a greener economy, to the exact point here. Again, we are tracking in real time some of his comments. They're speaking as we speak. He is abroad over in Stockholm. We'll continue to monitor those comments there. Let me ask you about earnings season. Honestly, kicking off in earnest here. We always say kicking off in earnest. That's always the phrase we use, right? We talk about the big banks here going first, but there's a lot of concern about, maybe some lofty expectations for earning. All this against the backdrop of a slowing economy, persistent inflation. How concerned should investors be? Specifically as you and I are having this conversation now on the Tuesday, and we are inching closer and closer to what the big banks will have to say to kick things off.
I think this earnings season is going to be incredibly important. And I think the fact that the banks are going first is not only a good thing, because it will give us that sort of visual perspective, but it is also sort of indicative of where the bulk of the risks lie. And that is going to be in credit growth, in interest rate risk and ultimately how those affect the U.S. consumer. That is going to be played out in an interesting way. The banks will very likely report a pretty notable decline in net income for the fourth quarter, certainly when compared to 2021 levels. Deal making has fallen off a cliff. Capital markets activity isn't nearly the same as it was in that year ago period. But the big difference in these numbers, JD, is going to be how the six banks sort of calculate the amount of money that they need to set aside in order to absorb potential losses in their loan and credit books. Now, these loan loss sort of provisions, which will be detailed by each of the six banks when they report, could be as high as 5.7 and maybe even as high as 6 billion US dollars. That's about a 50% increase from this time last year. That is likely to be taken by the market as a signal of potential consumer pressure and therefore a pullback in lending from these banks and simply another sort of piece of the recession puzzle. When the banks are setting aside that kind of capital that they can't use for their own growth and simply to absorb potential losses, it's never a good sign for potential growth. So the market will not only be looking at what the banks have to say with respect to earnings generation, but where they peg those loan loss provisions. That's going to be key.
It might be an impossible question for you to answer. If there is one individual piece of data you will most be listening for in these earnings reports come Friday morning, and I ask, in case we got viewers that are saying, well, I want to listen in, I want to know what to look for, what do you tell them?
Probably the easiest to digest and the most comprehensive will be the shareholder letter that is published by JP Morgan CEO Jamie Dimon alongside their numbers on Friday morning. He always gives a very broad assessment of the U.S. economic condition, what he anticipates for growth, for inflation, for unemployment, and a whole host of things, how he feels politicians should respond with respect to the economic challenges. He'll have a few words, I'm sure, about the Fed interest rate policy and what it's going to mean. It's quite long, quite detailed, and at times difficult to follow, but for the most part, it is very accessible. He's a reasonably good communicator in that regard. So I think if there is one thing to pull out from the Friday morning numbers, Jay, it will be that shareholder letter, and it will be published soon after the results hit, probably around 5:30 in the morning on Friday.
Yeah, and some of those letters last year, he was very clear to say we are facing challenges at every turn. It's oftentimes that annual shareholder letter in and of itself that makes headlines, and people can, you could head online and try and check out the top 4, top 5 takeaways, more or less separate from what the rest of the report has to say. So that's a great piece of guidance. That's what I was hoping for, something like that for people to say, cool, what's something kind of smaller, actionable, a bit digestible for me to kind of sink my teeth into come Friday morning. And you expect that pretty early. You said like 6:30 or so?
Yes, I think somewhere between 6 and half 6, if history is any guide. In point of fact, we'll probably get all of the 3 large Friday banks reporting in that small window, Wells Fargo, Citi, and JP Morgan. So that'll be a busy time.
Yeah, absolutely. Well, I certainly know that you're awake because I don't think that you ever go to sleep based on the time that you file stories with your byline up on the site. I do want to shift our attention now to the crypto space, if I can. Coinbase announcing plans here, Martin, to slash 20% of its workforce, marking the second round of job cuts for that company alone. What do we know with regards to the details?
Yeah, about 950 jobs are likely to go, JD. That's the anticipation. They're going to have to book a charge for about 160 million to pay for the severance and all the rest of it. But the large concern, of course, is what this means for Coinbase with regards to its position in the broader crypto space, where it's seeing that space going this year and indeed beyond, and what it might have to say about projects that they had planned. Now, the company hasn't said too much about that, only that they really have to react to market conditions right now. But this is their third round of layoffs within the last 12 months. And this is a shrinking business. And I think this is going to be one that is going to find it difficult to recover from. And it certainly won't be anything compared to what we witnessed in the latter part of 2020 and for the most of 2021. Last year, crypto gave back about $1 trillion in market value. And this is not a binary situation where somebody wins and somebody loses. A lot of this was just completely evaporated. and consumers, particularly retail investors, have taken a big hit along the way. Venture capital investment in the crypto space has fallen off a cliff as well. It's down about 75% from 2021 levels. So people aren't building out new projects. Coinbase is pulling back. Volumes have fallen through the floor. And this is really something I think that is going to characterize the crypto space for much of this year and perhaps even beyond.
So I don't sense the crypto winter thawing anytime soon. Hope everyone's got their mittens and their hats. It's cold out there.
It is very cold, and I would get a scarf as well if I was somebody who was involved in that industry. I mean, Brian Armstrong, the Coinbase CEO, actually said, without being specific about FTX, he talked about the contagion of sort of the unscrupulous players in the marketplace. But we all know essentially who he's talking about. And there were reports last night that Nishan Singh, who was the chief engineer at FTX, had made a visit to prosecutors for the Southern District of New York last week, potentially to become cooperative with their investigation into the collapse of that crypto trading platform and the contagion, of course, that it created all across the space. Caroline Ellison and Gary Wang, two senior executives at FTX, have already flipped, essentially, and are going to cooperate with prosecutors. Sam Bankman-Fried, as we all know, is facing 8 different counts of fraud and conspiracy related to the collapse. What's interesting, JD, and I think you'll like this, Nishad Singh is a significant Democratic Party donor, and his cooperation in this investigation may be centered around the millions and millions in donations that were made by FTX to lawmakers on both sides of the aisle, but certainly favoring Democrats at the margins. So this may indeed accelerate some of these discussions about potential clawback, finding out who received money and who didn't, and whether or not that affected the ways in which they attempted to regulate the industry. So there's still many, many threads to pull from this sweater. And as a result, again, that contagion, without being fully understood, is going to linger over the industry throughout the year.
And I wonder to what degree it may also linger over the members of Congress themselves. Several of them have been very clear to say we're going to give the money back now that we know what we're dealing with. That's going to be a really fascinating story to follow, especially now that at long last, Martin, I don't know if you heard, we finally do have a House of Representatives, and we do officially have a seated 118th United States Congress, the great deliberative body that it is. Great with maybe a small asterisk. Okay, yes, we just hit Bankman-Fried. Okay, you want to hit rapid fire? We ready for rapid fire?
Let's do it.
It's like a minute to 10. Okay, okay. Onto our rapid fire section we go. First up, let's go. Is Broadcom about to lose a big customer? Martin, what say you?
Certainly appears so. Bloomberg is reporting that Apple is accelerating its transition to in-house chip design, and as a result is going to drop some of the products made by Broadcom, particularly those that connect Apple devices to Wi-Fi and Bluetooth and other things, and use their own. That would absolutely be significant for Broadcom because it's responsible. Apple is responsible for about 20% of their annual revenues. I was quite surprised that Broadcom stock didn't react more significantly as a result of this, and perhaps investors are just looking for a bit more detail and a bit more flesh on the bone. But Bloomberg's reporting is usually pretty good in these circumstances, and this could end up being quite significant, but probably, again, might already be priced into the stock, given the fact that we know Apple is trying to make this transition over a number of years now and just continues to do so.
Absolutely. The Apple story in and of itself is such an important one to follow, and it seems as if it is a company here, Martin, that makes headlines, understandably so,
Sure.
Day by day. Actually, we're gonna do a real live check as we talk. I want to get a sense on the market cap. Yes, okay, it's back over $2 trillion market cap here. Yeah. Oh, we had a couple gains in the Nasdaq here last few trading sessions. Remember, that was a big storyline. It dipped below 2 trillion. It's now back about 1. Still number 1 in the world, Saudi Aramco, Microsoft, Alphabet, then Amazon. But it's fascinating to me in terms of market cap. You talk the top 5. So you think, okay, yeah, Apple and Amazon are very close. They're not. They're nowhere close. The gulf between like 3 and 1 is massive, and that speaks to why Apple is so important and so outsized. On to number 2 we go. Can BBBY, Bed Bath & Beyond, avoid bankruptcy?
They have a really difficult task ahead of them. There's no question about it. What we are seeing now, however, is a lot of meme stock investors who propped up the shares last year, and indeed during the frenzy of 2021, are back in the stock, perhaps trying to jockey for position and to see potential gains if the company is able to avoid Chapter 11. But that might prove to be a pretty risky endeavor. The company reported a deeper than expected third quarter loss of about 393 million. Sales are down about 33% from last year to I think 1.26 or something like that. They pre-announced this last week, but the loss was a bit deeper than even the pre-announcement. The company says it's exploring all paths. It had said last week that Chapter 11 might be an option for them. They're going to close stores, cut costs, and do all the rest of it. But it's a company that has lost its way so significantly that you do wonder whether or not the financial pressures are going to be so extreme that it can avoid that filing. And reporting suggests it actually could come over the next 2 or 3 weeks. So we'll watch that closely, but it's always worth warning investors. If you are a holder of Bed Bath & Beyond shares, you are essentially deemed an owner when or if this company goes into bankruptcy protection. And as a result, you are at the very bottom of the pile in terms of having your capital returned. In certain circumstances, so-called equity committees can be set up and some money can be set aside to satisfy those claims. But in the vast majority of Chapter 11 cases, equity holders get absolutely nothing, and the bondholders get whatever is left of the husk of the operating entity. So for those who are searching for a quick return in the hopes that they're going to find something from this Chapter 11 proceeding, as a stockholder, beware.
Husk of the operating entity would also be a good alternative name for the show. We're going to put a pin in that and come back to it another time. And by the way, shares here are up for BBBY 28%, meaning it's trading just above $2. But of course, you got these pretty stirring reports here about its brutal holiday quarter. Number 3, is Microsoft about to make a huge AI investment, Martin?
This story is really interesting, JD. The assumption is that Microsoft is going to put another $10 billion into OpenAI, which is an artificial intelligence company founded by, amongst others, Elon Musk. We couldn't go through a single program without mentioning Elon Musk, and we got there at the very end. Essentially, AI is the author of this ChatGPT chatbot program, which essentially uses human prompts to create text, to create stories, and will ultimately replace us all, if we are to believe the hype, in terms of journalists, teachers, authors, and everybody else. I don't know what we'll be all doing when this time comes, but nonetheless, Microsoft sees it as potentially important. I'm kidding a little bit about it taking over the world, but I think what Microsoft sees is the potential for this chatbot to be embedded potentially in the release, or the new release that we have been reading about, of the Bing software engine. If Microsoft is able to find a way to marry the two and put out a new search engine that might offer a potential challenge to Google, that could be really interesting. But that's a lot of money. It would be an $11 billion investment all told if the reports turn out to be true. And it would give Microsoft ultimately somewhere around a 50% stake in this OpenAI tech group.
You know, it's interesting, most of Elon Musk's tweets as of late have not been the spread of conspiracies. They have not been about the Twitter drop and the Twitter files. They've actually been back about SpaceX. He's back kind of in the rocketry lane a little bit, whereas for several weeks, it seemed as if the only thing he was tweeting about were things earned him negative headlines. He's not, listen, he's still tweeting back and forth with the Glenn Greenwalds of the world from time to time, but most of these are tweets about rocketry. Maybe that's what people want to say. Fourth and final here for our rapid fire section, my friends. The Golden Globes are back, something I admit I only learned right before the show when I learned that this was a question. Who's taking home a trophy? Please teach me and others who were woefully unaware.
Yes, indeed. Golden Globes, is one of the stream of the award shows that we tend to enjoy over the first couple of months of the year. They were canceled last year as a result of some concerns about diversity within the award-making group. A lot of Hollywood actors, directors, and other bigwigs pulled away. Comcast dropped it. They brought it back this year as a result of changes within the Golden Globes operating system, if you will, and as a result is going to be back on television. The Elvis biopic is slated to potentially win the top prize. The Avatar sequel, The Way of Water, I'm not sure if you've seen that, is also favored to maybe take home one of the top trophies. A couple of other names in the mix include the Top Gun Maverick sequel and a couple of other names as well. But all of this indicative, JD, I think, of the sort of changing nature of movie influence on the way that we consume our popular culture. These sorts of things, not just a few years ago, were incredibly important. I think it's telling that you weren't even aware that this awards program was coming back on television. I confess I wasn't either. And again, that just sort of speaks to the changing way in which we consume these things. And that has big implications for theater chain companies, for the streaming services, and everybody else that's involved in this sort of cultural change. I mean, Hollywood has been a colossus in terms of defining the way that we consume entertainment for the past 100 years. But that's changing really quickly. And the fact that the Golden Globes are back, but not with anything close to the same fanfare, is simply part of that narrative.
Absolutely. To be fair, in good faith, my lack of knowledge of the Golden Globes may not be fully representative unless there's a series of awards given to dramatics or theatrics on the floor of the House of Representatives, of which there are many awards that I would like to give after the shenanigans we saw the last week. There's a lot of acting in more ways than one. I might not know. You mentioned, before we wrap up here, Top Gun Maverick was the greatest piece of anything that I watched in the last year, and I wonder what your favorite either show, movie, anything was that you consumed since last award season till today.
Boy, that's a great question. I'm not a monstrous consumer of that sort of thing, but I did enjoy, I have to say, against my better instincts, The White Lotus, both the season 1 and the season 2. I thought they were really intelligent vignettes of sort of American culture, obviously at the higher end of the income scale. But I thought the way it was written was quite clever. I thought it was entertaining and ultimately sort of raised more questions with the ambiguous endings, which is not typical of Hollywood. So as a result, I found both of those quite entertaining.
I admit I did not watch season 2, though my old good friend Natasha Rothwell was in season 1. She did an incredible job. I've known her for years, and I was a big fan of it. I do need to watch season 2. I admit that I'm a little bit behind on that, but I'm doing a rewatch of The Sopranos right now. Not up for award show contention all these years later. When I wrap with Tony and the crew, I will have to hit White Lotus season 2. We will see what the Golden Globes have in store. The great Martin Baccardax, thank you for letting us get smarter together every morning, as always. We'll see you soon. Thanks, Martin.
Excellent. Thanks, JD.
You got it, brother. All right, folks, that is going to do it for the Market Open. Stick with the street for more on these and all of the major market stories that matter to you, and we will see you tomorrow.